Today we are going to show you why it is so important to understand the power of financial efficiency and how to create a multiplier effect on your money. Financial efficiency means making sure that every dollar you have is working as hard for you as possible. And it is the building block for producing what we call the multiplier effect on your money. So you might ask this question: is every dollar you have providing you the maximum benefit or return possible? Or said another way, is every dollar you have employed at its highest and best use? The multiplier effect then begins to build on financial efficiency once you've got your money working hard to create the maximum benefits for you. Then the next step is to have each dollar provide multiple benefits, meaning every dollar is creating multiple results. In effect, $1 is doing the work of $3 or $5 or even more. Understanding how to create financial efficiency and implement the multiplier effect will dramatically enhance your financial future, as your money is now working much harder for you. So let's look at how the concept of financial efficiency and the multiplier effect might work together for you. To better explain this process, we're going to talk about setting aside or saving $500 a month. We're going to walk you through a series of financial steps with this account that will demonstrate financial efficiency and the multiplier effect in action. So let's assume that you can put this $500 a month or $6,000 a year into an account for 20 years. If you did not receive any interest on this account at the end of 20 years, you would have a balance of $120,000. This is not very financially efficient. So let's add some interest. Until recently, interest rates were relatively low, so 2% might have been the best you could get. And if you were in a combined state and federal tax bracket of, say, 30%, at the end of 20 years, with your money growing at 2% taxable, you would have a net after-tax amount of $139,307 in your account. You have now increased your financial efficiency by adding some interest to the process. Pretty simple. The effect is that your supply of money has been increased by $19,307 because of the interest that was added to your account. But let's see what happens to your money supply if we can keep the tax man, or better known as the IRS, away from your account. If the account is now growing tax-free, at the end of that same 20-year period, you would have $148,700, of which $28,700 is interest. So by eliminating the tax on the growth of your account, you ended up with nearly 50% more interest. That's a significant improvement over having a taxable account. Now, the next step in creating greater financial efficiency is to find a way to increase the interest rate without increasing risk. What if we applied a 5% interest rate with no taxation? Now your account has grown to $208,316, and you have earned an astonishing $88,316 of interest. Over $88,000 of interest by getting a little higher return and eliminating the tax. Eliminating the tax burden created more money without increasing your financial risk than by you looking for a way to earn a higher rate of return, which generally involves greater risk. So now it's time to add the concept of the multiplier effect. The multiplier effect looks at where and how you store or position your money. And until now, in our example, we have initially been looking at storing your $500 per month in some type of interest-bearing savings account where you did not have to pay taxes on the interest. In order to be able to create the highest degree of financial efficiency and produce the greatest multiplier effect, you're going to need your money to be liquid, so you have unrestricted access to it. You would also not want it to be subject to market loss, so you could be assured it would be there when you needed it. Now, there are very few places that meet your criteria, which is necessary to create the greatest financial efficiency and produce the largest multiplier effect. The most effective place to store money that will provide you the greatest financial efficiency and produce the largest multiplier effect is in a very misunderstood financial instrument. That financial instrument is a strategically designed life insurance plan, just like the ones that the wealthy have used for decades. By storing your money in one of these plans, not only do you increase your financial efficiency, but you also begin the process of the multiplier effect, and you are protecting your capital as well. Inside life insurance policies, money grows without current taxation and can be withdrawn tax-free. You also have the benefit with life insurance of a death benefit, which most people want and need it anyway. Cash values can be used as an emergency fund, an investment opportunity fund, such as real estate. The cash values can also be used to provide a college education or pay cash for a car. The uses for cash in a policy are endless. The result of utilizing a properly structured life insurance policy as part of your overall financial strategy is a smart move, as it is designed to create financial efficiency and the multiplier effect while significantly increasing your money supply, as well as providing a tax-free source of supplemental retirement income in the future. To learn more about how utilizing a life insurance plan to create financial efficiency and the multiplier effect, please click on the link below to see some examples of this financial concept and strategy in action. We believe you will find the information in those videos very, very powerful and very important to you.